On Capitol Hill, we still hear a lot about the debt trap. The Chinese at FOCAC were saying the debt trap narrative is ridiculous because the Chinese only account for 11% of the continent's total debts. And you pointed out that multilateral debt and also private bondholder debt is considerably higher. Help us put this 4.61 billion that you found in 23 and then the larger number, the 182 billion from 2000 to 2023 into a context relative to the others. Who's right here? Is it the Chinese when they say we're only 11% of the total, or is it these critics in Washington who are saying debt trap, debt trap, debt trap?
We have to talk about affordability in terms of interest rates as well, because if we look at back to the 2023 data, right, we see that there's 3 concessional loans, right? And then in terms of the commercial loans, for instance, the loan to Nigeria, the interest rate is a 5.4%, which is below sort of what, the interest rate typically charged to Africa is right now in terms of, we're talking 7 to 10% if you want to issue bonds or borrow from other commercial creditors. So I think that also is another point to consider in terms of the cost of the financing.
The bondholders, when they participate, they have been having to give the least amount of debt relief to the countries that get debt relief. And so China can be criticized for not really stepping up. But if you look at China that gave the most debt relief under the Debt Service Suspension Initiative, and then they're sitting there being asked to give even more, but despite the fact that bondholders charge such a high interest rate, they have to give the least amount of debt relief. And then multilateral development banks are exempt. China says, gosh, it's not fair for us to give more debt relief because the countries aren't going to take that debt relief and invest in education, health, and climate. They're actually going to have to turn around, and our data shows this, and other data that's out there. Capital flows to African countries this year are negative, so any debt relief that China would give to the region, they'd turn around and pay a bondholder in New York or pay the World Bank or the African Development Bank, and they don't see that as fair.
The China Global South podcast is supported in part by the Africa-China Reporting Project at Wits University in Johannesburg and by our subscribers. Thank you. If you'd like to subscribe for daily news and exclusive analysis about every aspect of China's engagement in Africa, Asia, and throughout the developing world, go to ChinaGlobalSouth.com/subscribe.
Hello and welcome to another edition of the China Global South podcast, a proud member of the Sinica Podcast Network. I'm Eric Olander, and as always, I'm joined by China Global South's managing editor, Cobus van Staden from Cape Town, South Africa. A very good afternoon to you, Cobus.
Good afternoon.
Cobus, it's been a few weeks now since the Forum on China-Africa Cooperation Summit wrapped up in Beijing. And as we expected, the big number that came out of the event is the big headline that a lot of media in Africa and elsewhere are focusing on. So they talked about $51 billion of new pledges that came out of the summit. And unfortunately, a lot of the media framing of this $51 billion is highly misleading, grossly ill-informed, and in many ways stuck in a generation that is long gone. So there's a lot of assumption that says, see, China is not disengaging from Africa because there's this $51 billion of commitments that's going to be coming over the next 3 years. But as we looked more carefully through the numbers, and a lot of scholars like Professor Lina Ben Abdallah at Wake Forest University, she detailed on X as well, there's some fuzziness in these numbers, and it's not the China of old when it comes to lending for these huge infrastructure projects like the Standard Gauge Railway and others. As you've looked at the media coverage and you've processed in the post-FOCAC era what this $51 billion is, what do you think of how people are framing it and in many cases misunderstanding it?
I think it's part of a bigger problem that there isn't in general enough kind of hard-nosedness about these kind of announcements. So this is true for the Chinese one, but it's also true for a lot of the other Africa Plus One summits, as well as some of the deals that we're seeing under the EU's Global Gateway, for example. In all of those cases, there's a lot of recycled numbers, there's a lot of kind of projected targets for corporate investment, for example, that aren't necessarily, that depend on actual choices made by corporations that may not fall into into place. And so, like in general, I think we and African journalists particularly need, I think, a bit more hard-nosedness in terms of unpacking these numbers. And frequently what that reflects is just the difficulty of dealing with these numbers to begin with.
So if you recall, and I'll do a very cursory breakdown here, $10 billion of that $51 billion is allocated to foreign direct investment. That's very similar, Cobus, to what you talked about, how the Americans and the Europeans were talking about rallying their private sector to get more engaged in Africa and the global south. Of course, that really doesn't belong in a state-to-state type of deal because it's not state funding. Another 10 billion or 11 billion around there is going to be dedicated for what they called, direct assistance. Not really a lot of money because when you look at the economy the size of China at $14-15 trillion, providing $3 billion a year of assistance to Africa, especially across 54 countries, not really a lot of money there. And then the other 30 billion or so is in the form of mysterious credits, export credits, import credits, buyer's credits, all these different kinds of credits. One of the problems, though, is that we don't have any mechanism to verify how those credits are being used, where they're being used, and whatnot. So lots of fuzziness in there. What is not included, as far as we can see, are large, big-ticket loans from the state policy banks, China Development Bank and the China Exim Bank. Now, there might be, again, in that credit bucket, there might be some of that. But what we do know, though, so we don't know about FOCAC, but what we do know is new data that shows that Chinese lending to Africa rebounded a lot. And so Chinese lenders approved loans in 2023, $4.61 billion. Now that is up dramatically from the previous year of just $922 million. In all, there were 13 new commitments to 8 African countries and 2 regional financial institutions. So this was the biggest jump in lending since 2019 before the onset of COVID-19, and it's the first annual increase since 2016. So all of this data came out of the Boston University's Global Development Policy Center's China-Africa Loan Database. And we are thrilled to have the folks who are there at BU to put some of this data together. And 2 of the members of that team, Kevin Gallagher, who is the director of the Global Development Policy Center, and Diego Morro, who is the data analyst for the Global China Initiative at Boston University's Global Development Policy Center. Diego and Kevin, thank you both for taking the time this morning to join us.
Yeah, thank you so much.
Glad to be on.
So big headline there. You guys got a lot of attention earlier this summer before FOCAC about the uptick in lending from $922 million in 2022 to $4.61 billion in 2023. Kevin, let's start with you. Give us the background of what do you think accounts for the turnaround in Chinese confidence in lending to African countries?
Well, a big part of why China wasn't engaging in Africa is because it was on a big lockdown and they weren't flying to Africa to cut big deals. No one was flying in or out of China at all for a few years. It's an interesting uptick that has overcome that. Obviously, China is open for business and Africa needs financing now more than ever.
Diego, do you get a sense that when one talks about project finance and project lending, do you get the sense that this uptick is kind of comparable one-to-one to what we saw before the pandemic? So what I'm asking is, are we seeing different kinds of lending or different kinds of like deal structuring happening now that we didn't before? Or is it essentially a kind of a pickup from, where they left off before the pandemic?
Yeah, so that's a really interesting question, Cobus. And I would answer that, yes, it's different. And I would like to, highlight a few points to defend this argument in that, first, we see that the composition of the lending of this year, right? 2023, I should say. 13 loans committed worth $4.6 billion. This is the first increase since 2016, as Eric pointed out. And I do want to also highlight, if we had to compare it, right, in terms of the cumulative amounts, right? So in total, Chinese lending to Africa since 2000 is 182 billion, right? And the World Bank, on the other hand, similar time period is 209 billion. So it is within the same order of magnitude in terms of amount. And also compared to the African Development Bank, which has committed loans of 86 billion, China is approximately double that. So just to contextualize here in terms of amount, but I do want to talk about composition as your question asked. It seems to be that the focus now is mainly on financial sector lending. So if we look at the loans from 2023, more than 50% are going to financial sector, so banks And for instance, we have on-lending facilities and trade finance loans going to African development banks. You also have liquidity loan going to the Egyptian central bank. So when we look back at sort of what has happened before 2023, the cumulative, right, we see that finance is only 5% of it, right? So it is a change in the composition here. Also, energy is another thing. So energy used to be, or energy, if we look at the cumulative composition, is 34%, right? That's the share. However, in the past couple of years, there's been a hiatus in energy lending, and it has returned in 2023. So I think there is a difference between what we're seeing now and what we saw during sort of the peak years of the BRI, when we saw annual commitments really hit 10 billion on a yearly basis.
Yeah, if I could just add three key things here. In the composition is slightly changing. We're seeing a return to energy, but also China coming true on its pledge to move away from coal towards green energy. There's no coal plants like there used to be. All the energy pledges are green energy, and this financing is really interesting. One, obviously the region is financially strapped, but it's a lot of on-lending to other regional development banks so that they can take on a little bit more of the risk, and also some rescue finance for Egypt and elsewhere. But there are a couple loans in here that are old school, returning to the infrastructure that the region needs.
So I just want to understand this lending to the financial sector, because it's a pattern that we've seen in other parts of the world as well, where the Chinese are using these, credit swaps and these emergency financing that they're giving to Pakistan and to other financially distressed countries. Is that the same thing as what's been going on in Egypt and these financial sector loans in Africa, or is what's happening in Africa different? Diego, do you have a take on that?
Yeah, I do. So you do see some of that, right? So there is, for instance, a liquidity loan to the Egyptian central bank, and it's a liquidity support facility that addresses balance of payments related issues. And I'm sorry to interrupt you, Diego, just for our listeners who may not understand why that's important and what that means, can you explain that in more layman's terms? Absolutely, right? So I think you put it well in your question, right? So what you're seeing is more of these credit swaps and, liquidity lending. And what this is, as countries have to maintain their balance of payments and make sure that they can afford the imports, right, that they currently getting from other countries, and they have sufficient financial leeway and they need to sometimes tap into, a credit facility that another country offers them, right? So it was through, bilateral credit swaps, or also you have, liquidity lending, right? So that is one aspect that we have seen here in the Chinese loan commitments to African borrowers in 2023, as I mentioned, right? The Central Bank of Egypt loan. However, this really isn't the main thing. I would say that most of the lending that is going to the financial sector is actually based on the lending to development banks. So the African Export-Import Bank, Afrexim Bank, right? So the Africa Finance Corporation Bank, they are borrowing from China for on-lending to small and medium-sized enterprises in member countries in Africa, right? So to promote development and economic growth. And also you have trade finance facilities. So China is lending money to these development banks to then promote finance, whether it's intra-Africa or Africa-China. So it's not always explicit. And yeah, I would say that is really the key finding in terms of what we're seeing with the majority of the loans going to financial entities. And I do want to point out that, as Kevin already did, really this is a risk mitigation strategy, because there are several advantages by sort of outsourcing the lending to these development banks, right? First one is that they have more in-depth market expertise. Second one is the reduced risk, right? Because there's less. These banks have better credit worthiness and score as opposed to maybe sovereign lenders, and as sovereign borrowers, I should say. And finally, this can also promote Chinese trade with these developing countries. But we also have to contextualize this, and we do in the report, which is, on the one hand, you see this risk aversion, but then it's accompanied by lending to struggling borrowers in the case of, for instance, Egypt, Nigeria, and Angola. So it is interesting to see China sort of being pulled in these two different directions.
Yeah, it's important to think of this, the lending to the financial sector. There's two different kinds. There's liquidity support and there's long-run development support. I think of liquidity as short-term shots in the arm for countries that are having trouble making payments either domestically or internationally. And think of the development finance as sort of on-lending to other regional development financial institutions so that they can lend to other parties in the region. And one thing to be clear about is that we don't include swaps from the People's Bank of China in our data set. That's sort of an apples and oranges kind of thing. We have a different database called the Global Financial Safety Net, which track People's Bank of China swaps that have been playing a useful role around the world in helping countries deal with larger liquidity issues. But what we do find, which isn't new, you've reported on this in the China Global South project over time, is China Development Bank or the Export-Import Bank of China providing liquidity finance to either the country's finance ministry for its fiscal budget or to the central bank in terms of being able to provide liquidity support there. And so for 2023, we find an interesting CDB loans to the Central Bank of Egypt, which has been in some really dire straits, so that they can play a role in some short-term liquidity issues, whereas these loans to the Africa Finance Corporation or the Africa Export-Import Bank is a way to for a big player like Checksum not to have to give lots of little loans to small and medium-sized enterprises across Africa. That's just not in their business model. But to on-lend it to a large regional institution allows them to reach those kind of borrowers, but it also, as Diego notes, allows them to multilateralize the risk a little bit so that a lot of the risk is borne by a different entity and not necessarily Checksum.
And Kevin, just returning to the People's Bank of China swaps, this week a senior Treasury official in the US was, raising caution about these swaps from a US government perspective and calling on the IMF to be more explicit in how they count those as part of developing country reserves. So I was wondering if you could explain a little bit, how are these swaps different from some of the other mechanisms that you pointed out, and what you make of this alarm call from the US Treasury?
Yeah, I think the alarm from the U.S. Treasury, part of it is very warranted, but part of it we have to take with a big grain of salt. So the People's Bank of China is offering currency swaps, has been for a long time. We track them in our Global Financial Safety Net data set. Two different central banks to help them with liquidity issues and to help with trade finance in renminbi. And this is China really stepping up in the multilateral scene to add layers to the Global Financial Safety Net, which is really, really weak. And in Africa, according to our research, it's the weakest. Think a lot of countries can go to the Federal Reserve for a currency swap. Other countries can go to regional financial institutions to get swaps or to get lending for financial pinches. But Africa really only has the International Monetary Fund. One, that's only one choice. And two, it's very different than what you get if you're, say, South Korea or Europe, right? If you get a currency swap from the US or from the European Central Bank, you're allowed to therefore be expansionary, right? To spend more money to try to get your economy going during a slow period. But as we saw so unfortunately in Kenya this summer, the way that the IMF works on it is that they require a country to tighten up and go in the reverse, which can often have some significant social and economic problems like we saw in Kenya this year. So the U.S. government was criticizing China's engagement on this. We wouldn't agree with that. We're really concerned about the weakness of the global financial safety net and the asymmetrical nature of it. And so we applaud China for playing this role. However, we'd have to agree with the U.S. on the lack of transparency about how these are accounted for and what they look like. In fact, obviously, the two data sets that we track on this stuff, the Global Financial Safety Net tracker that tracks the currency swaps around the world, and our China Loans to Africa databases, in addition to all of our others, are trying to create more transparency about Chinese overseas economic activity. And so we'd agree with the call for the alarm for China to be more transparent and to allow this stuff to be tracked, to put places like the GDP Center out of business on tracking this stuff. We'd rather just download the data and do the analysis, but it's important to try to create more transparency for analysis and accountability. So we'd agree with the U.S. on transparency, but the U.S. Should be applauding China for providing this kind of service. The U.S. has been reluctant to reform the International Monetary Fund, and the United States Central Bank has been very reluctant to provide currency swaps for many of the countries that China has. So China's filling a gap, but it should be more transparent.
No concern that the GDPC is going to run out of things to do anytime soon. I can assure you of that. Diego, just this week, in fact, the Kenyan Treasury took delivery of $279 million, a new loan from the China Development Bank that was signed at FOCAC. And it highlights one of the trends that you revealed in the data set, that about 5 countries stood out in terms of where Chinese money went to, including Kenya, also Angola, Ethiopia, Egypt, and Nigeria. You kind of pointed out in the report, and your co-authors as well, I should say, that it's a little bit surprising in some respects that countries like Angola, that account for almost a third of total Chinese debt in Africa today, are receiving more. And we've heard about debt distress in Kenya and in Nigeria as well, and yet the Chinese are giving more money to these countries. Can you talk a little bit about those 5 countries and what that trend reveals?
Yeah, absolutely. So, well, first of all, I do want to thank the co-authors, Lucas and Jijong and Victoria, who have helped tremendously in writing this report. So thanks to them. And thank you for your question. So as you mentioned already, these countries are very important. I mean, not just because Nigeria, for instance, is the most populous country in Africa. Egypt is the most populous country in the Middle East. Angola and Nigeria are rich in natural resources. And, there's a lot of reasons why these countries are strategically important, but also especially vis-a-vis China, right? Because as you mentioned, the debt with Angola, but also Angola depends really on exporting to China oil. So Nigeria and Egypt, for instance, they are one of the biggest trading partners is China. They import, China is their leading importer. So they import a lot from China. So it's very important to understand the relationship between these countries. But if we look and sort of zoom in, right? So for instance, in the case of Nigeria, had high inflation, and this obviously affected the currency there, and it made it more difficult to attract investment. And it was similar to what you saw in Egypt, right? And we sort of alluded to this earlier, right? In terms of the balance of payment situation. And finally, in the case of Angola, you had a very swift drop in the prices of oil. So that affected a lot the revenue that was coming from the exports. So regardless, China has continued to lend to these countries. And I think that, part of it is, I think it's explained by the fact that, these countries are strategic partners for China, and they've continued to double down on them despite the risks associated with them. And I think it makes sense in the case, for instance, in Angola, they're reliant on this Chinese revenue. I don't think China is just going to abandon them, right? So it does make sense. And Nigeria, like I said, there's a lot of investment, right? And Chinese investment. For instance, the Chinese railway companies, the Chinese Railway Corporation earns the most revenue in that country. So it is of strategic importance. Same with Egypt, right? The trade going through the Suez Canal, these countries are really important. So it makes sense to see China really allow risk mitigation to somewhat take a backseat here and really prioritize these countries specifically.
Kevin, I'd like to ask you quite a broad question. Over time, a lot of the mechanisms of Chinese lending have come in for a lot of criticism, particularly from Western stakeholders. Some of the criticism we've criticized, in terms of particularly the narrative of the debt trap. But other criticism around, for example, transparency that you also raise, I think is warranted. But a lot of the tools in Chinese lending, particularly, for example, the use of escrow accounts and so on, are forms of de-risking. Are you seeing some of these tools being taken over by other lenders? Are you seeing a general kind of Chinese influence in other forms of lending to Africa and the poorer part of the global south? Or is it still a situation where these are seen as kind of distinctly Chinese kind of instruments?
Well, Diego, really quickly to just clarify that we don't find any commodity-backed loans this time, right?
Correct. We see that there's no indication that any of the loans, for instance, from Angola have been backed by any resources or...
So actually, escrow accounts and things of that nature, that's fairly commonplace. I think the one thing that was largely distinct in this century was the use of commodity-backed loans. If you look at earlier years in our data set, you'll see that some countries would back some of the loans with oil, some with cocoa beans, others with diamonds. And that was distinct for China in the 21st century, although that was started by the United States, actually in a loan to China that Harry Dexter White put together when he was at the Export-Import Bank of the United States. They were concerned they were going to give a loan to the Chinese government, but the Chinese were fighting a civil war and fighting a war with Japan, and they wanted to make sure that the money wasn't going to be used for that purpose. And so we secured it in minerals and sort of started that model, and China ran with that. That's sort of the domestic model of the China Development Bank, but you haven't seen that. I think what China is very similar to what you call the London Club, right? So they give long-term bank loans. It's not bonds like the majority of overseas debt in Africa is, or not the majority, or the largest share is bondholder debt, where PIMCO, Standard Chartered, and so forth, countries are issuing bonds. The second largest is multilateral development banks, which are long-term development loans. And China's are more like that. It's more analogous. So the China Development Bank is more analogous to the World Bank or the African Development Bank, and the Export-Import Bank of China is a little bit of a mix between, say, a Export-Import Bank and IDA, International Development Association like entity, because those grants are what are called concessional grants, where they mix some grants with it to make the cost of capital go down.
Let's just expand on that context that you're kind of setting for us, because we hear quite a bit in Washington to this day. In fact, the Wilson Center, which is a think tank in Washington, just had a podcast on China, Africa. And the first question that comes out of the host's mouth is, the debt trap. On Capitol Hill, we still hear a lot about the debt trap. The Chinese at FOCAC were saying the debt trap narrative is ridiculous because the Chinese only account for 11% of the continent's total debts. And you pointed out that multilateral debt and also private bondholder debt is considerably higher. Help us put this 4.61 billion that you found in 23 and then the larger number, the 182 billion from 2000 to 2023, into a context relative to the others. Who's right here? Is it the Chinese when they say we're only 11% of the total, or is it these critics in Washington who are saying debt trap, debt trap, debt trap? Kevin, help us figure out and sort that through, because I think a lot of people hear both and are confused.
Sure, there's two different things going on here. One is an accusation that China's lending to Africa and other places in the global south is what's called debt trap diplomacy, number one. And number two is a narrative that China is responsible for Africa's debt crisis. And most countries in Africa are clearly in a very severe debt crisis. And both of them are true. Debt trap diplomacy, the premise is that China's purpose in giving a country a loan is not to build a bridge or to get access to or build a road, and that therefore can help the country grow and buy more goods from China or help get Chinese companies opportunities on that particular road or get access to cobalt or something like that. No, that's not the reason why China is lending. Those folks say that China is lending so the country won't pay the country China back, and so China can seize assets. And numerous researchers, the Rhodium Group, Deborah Brodigan and her team, over and over again, this has been empirically shown not to be the case. We've done a lot of work on the motivations of Chinese finance, and there's a lot of push factors, reasons why China wants to be investing around the world, especially in Africa. And obviously, there's such a need for investment in infrastructure and energy. There's a whole bunch of reasons why countries are begging China for financing. 50 heads of state just went to China for FOCAC. Right now would be the great counterfactual experiment of the debt trap diplomacy, because there's such a debt crisis and countries are having trouble paying China back. If China really was doing a debt trap diplomacy, then right now they'd be gobbling up ports and roads and third generations of people's children and taking over the global south. But they're not doing that. In fact, they've given more debt relief than any other actor in the global economy. So the debt trap diplomacy narrative is really a geopolitical one driven by sort of security hawks that is really problematic, because it's inflaming U.S. tensions. It's putting countries in the global south that need a lot of finance, and a lot of it's not coming from the West. It's putting them in a corner or making them feel like they have to choose, and it's very unuseful. So that's the debt trap diplomacy story. Now, the other problem is that the global south, and unfortunately many of the countries in Africa are the majority of it, are in the midst of what the World Bank calls a silent debt crisis. It's a silent debt crisis because no one in the West really wants to talk about it. But we know from the United Nations that 3.3 billion people in the world are living in a country that is spending more on external debt service every year than it is on investments in education, health, or climate finance. Not only is that just terrible for the livelihoods of people today, but by not making these investments today, you're really affecting their long-term growth path. And since we're talking almost half the world, this is going to have huge impacts on the global economy and the global ecology, because if we're not investing in development and climate now, we're going to see more of these just treacherous floods and droughts and other shocks that are really hampering livelihoods and the economies around the world right now. So on the silent debt crisis, if you look in Africa where all the debt stock is, as the Wilson Center said, it is just that we're all quoting the same data from the World Bank. China's debt stocks is only 11%. The largest amount of debt that's owed from African countries is to private bondholders and to multilateral development banks. But it's not necessarily the stock that you're concerned about because you don't have to pay the whole thing today. And in 2024, developing countries, especially African countries, this is the year where their payments are the highest. And payments right now, the composition's a little different. It's still about a third to private bondholders, a third to multilateral development banks. But China, even though it's 11% of the stock, is about a third of the payments that are due this year. And that's because China gave so much debt relief during what was called the Debt Service Suspension Initiative under the G20, and they suspended payments for a few years. Well, now all those suspended payments are due, and so debt payments are due to China, the multilateral development banks, and bondholders. So where there is some concern is that the multilateral system, including China, they're really struggling on providing debt relief and dealing with this debt problem. First of all, as China points out all the time, is with one of the big chunks, the multilateral development banks are exempt from the whole process, or the G20 Common Framework. They don't have to participate. And number two, the bondholders, when they participate, they have been having to give the least amount of debt relief to the countries that get debt relief. And so China can be criticized for not really stepping up. But if you look at China that gave the most debt relief under the Debt Service Suspension Initiative, and then they're sitting there being asked to give even more, but despite the fact that bondholders charge such a high interest rate, they have to give the least amount of debt relief. And then multilateral development banks are exempt. China says, gosh, it's not fair for us to give more debt relief because the countries aren't going to take that debt relief and invest in education, health, and climate. They're actually going to have to turn around, and our data shows this and other data that's out there. Capital flows to African countries this year are negative. So any debt relief that China would give to the region, they'd turn around and pay a bondholder in New York or pay the World Bank or the African Development Bank, and they don't see that as fair. So it's really important for podcasts like yours and the newsletter like yours to continue to have an empirical-based understanding about this, and it's good to hear that the Wilson Center was also talking about the core numbers here. Sometimes people conflate these two things. Debt trap diplomacy is sort of a geopolitical theory, and blaming the debt crisis on China is also unfounded. Africa's in a debt crisis. It largely has to do with external things that most African countries had nothing to do with. Number one being COVID. Number two being the wars and the related sanctions that are around those. And the big sort of the straw that hurt the camel's back was the interest rate fluctuations at the Federal Reserve really wreaked havoc in those countries that were the most fragile, and some that weren't managing their financing as well as they should have been. They just couldn't withstand this. And they're in a heap of trouble. And the world really needs to focus on this a lot more. And it can't be a bilateral thing. You didn't see debt relief, a big conversation at FOCAC because of this sort of collective action problem that I outlined. This is a role of the G20. This is a role of the International Monetary Fund. And unfortunately, the heads of state, especially of the largest high-income countries, are not willing to touch this, especially in an election year here in the U.S. And while there's all this gridlock, Africa suffers, and we're all going to pay for it in the long run.
So yeah, and just piggybacking on what Kevin said regarding the debt trap diplomacy is we have to talk about affordability in terms of the interest rates as well. Because if we look at back to the 2023 data, right, we see that there's 3 concessional loans, right? And then in terms of the commercial loans, for instance, the loan to Nigeria, the interest rate is a 5.4%, which is below sort of what, the interest rate typically charged to Africa is right now in terms of, we're talking 7 to 10% if you want to issue bonds or borrow from other commercial creditors. So I think that also is another point to consider in terms of the cost of the financing.
And Diego, just finally, one of the big narratives of Chinese project financing over the last few years has been the shift towards small is beautiful. Smaller project sizes, shorter repayment windows, and frequently mixed financing models. In this data, and looking at particularly at the uptick of lending, are you seeing that reflected? Like, are we seeing, for example, an increase in the number of projects kind of fitting into the larger number of lending, or is small is beautiful still more of a narrative than a full shift actually on the ground?
That's a really interesting question. And I would first start off with, if we look at the data, right, of these 13 loans, we see 3 that are energy loans, and they are all renewable energy projects, right? I think we have 2 hydro loans. One is for a transmission line in Uganda, and another is a power plant in Madagascar and the solar plant in Burkina Faso. So this is sustainable green energy. And I also want to add that they are all very small in size, whether you look at it in terms of megawatts, in terms of, power. If you look at it in terms of amount, right? I think it's about average energy for these is about $150 million. Whereas if you look at the size of an energy project by a loan amount on average since 2000 from China, it is about $300 million. So it's like half the size, right? So we are definitely seeing small. And I definitely think that we can't say that, Xiao Armei, the small and beautiful, is taking form, because although it is at a small scale, it's certainly, the loans certainly show that is sustainable and renewable energy focus.
The report is Relative Risk and the Rate of Return, Chinese Loans to Africa Database 2000 to 2023. This is the reference point that everybody needs when we hear about these discussions about Chinese lending in Africa, because this is the most authoritative data set that's out there, at least publicly available to us outside of China. Who knows inside of China if they have something more authoritative than what we see here. Diego, Kevin, thank you so much for taking the time to join us. We're going to put a link to the report in the show notes, and we really appreciate your time to help us better understand these critical trends.
It's been a pleasure. Thank you.
Great to be on again. Great to hear from you guys.
Cobus, I feel like I'm just going to lose my mind when I hear these guys talking, because, it's just infuriating when you listen to the broader discourse about Chinese lending in Africa and how disconnected, divorced from any kind of reality that exists out there in terms of the perceptions and the way it's being framed. And by the way, not just by the nimwits in Washington, but also by journalists in Africa. I spent an hour yesterday doing an interview with a Nigerian publication, and it was debt trap, debt trap, debt trap all the way through. And so the work that BU is doing in providing this baseline of data is so important, because it is the reference point to say, guys, this isn't happening this way. And again, it's very important to point out that Kevin didn't say that Chinese lending in Africa is perfect and it's 100% without criticism. It's not. There are problems with it. Just the problems that people are focusing on are not at all backed up by the data that Diego and Kevin and the rest of the team at GDPC reveal in their data set. And we have the data set. There it is. And this is not a new thing. This data set that they've been working on goes back years. Previously, this data set was run by Deborah Brautigam and the Johns Hopkins China-Africa Research Initiative. So this isn't something that just popped up on the scene, a month ago or last year. They've been doing this thing for years, and yet still the same conversations are happening over and over, and we're not moving this debate forward. That is tragic.
Yeah, absolutely. It's particularly problematic on the African side because what's really needed is concerted African pushback against some of these issues, both on for example, the transparency issues on the Chinese side, but more specifically around how broken the international financing system is and how grossly Africa is being overcharged. But we're still seeing that narrative mostly being pushed by NGOs. They're the people who are really kind of like focusing on this unfair kind of risk assessment that African countries suffer under, for example. We're not seeing that, on a conclusive basis being called out by African stakeholders. So some people in the government, some people in development banks and so on, but not conclusively as a unified voice in Africa. And that is really, really needed, because the continent is really treated very badly. And as Kevin was pointing out, there's very little political will in the global north to address this.
We used to talk about the African infrastructure deficit that was at about $100 billion a year. They said 10 years, $1 trillion. The African Development Bank has come out with new numbers this year that says now that's moving up to $150 billion a year, in part because less financing is coming into the continent to build infrastructure, so the deficit is only getting bigger. And so we have a problem here of affordable, accessible capital coming into Africa in order to close that infrastructure deficit that would then drive up productivity, which would ultimately drive economic growth and development. But yet that's not happening. And so rather than talking about this chronic infrastructure deficit and this financing gap that exists there, we're talking about Chinese debt traps. That is insidious. And the other part of this discourse that is so frustrating is how paternalistic, condescending, and patronizing it is when you have people, predominantly white people in Washington. Actually, it's not. Let me take that back. It's not only white people, because you have this rhetoric also comes out of the Black Caucus in Congress as well. So it's an American thing rather than a racial thing. And what you have is this patronizing discourse that Africans are too stupid to negotiate these loans with the Chinese. And so then they get ensnared in these debt traps. And that continues. I'm kind of bored of talking about the debt trap, but unfortunately, it's absolutely relevant to what we're talking about, because when we see data projects like this, it really shows that we have moved into what you've called into an era of disinformation, that these jokers can't do a Google search and find out on the first page of Google search results that there's data from places like the Boston University Global Development Policy Center. And as Kevin pointed out, there's been a lot of research done by Chatham House, Johns Hopkins, any number of reputable organizations that have debunked this. And so we're caught in this cycle. And meantime, the African infrastructure financing gap continues to grow.
Yes, I think one of the key problems, one of the really fundamental problems, I think, is that, in the Anglophone world, we are stuck in a world where what we understand as our reality is largely shaped in a few key American and UK cities, right? And I find it revealing, for example, that, as you were speaking with Nigerian journalists, that US talking point remains so dominant in Nigeria, even though this week also the Nigerian Finance Ministry, again, for the umpteenth time, made clear that they don't have a Chinese debt problem. Like Nigeria doesn't have a Chinese debt problem. And in fact, the Nigerian Finance Ministry was saying that they are interested in getting more loans from China, and China is interested in giving them more loans. So even in that context where the Nigerian state is actively addressing this issue, that's still not seeping through to Nigerian journalists, I think partly because their worldview is so shaped by what is in the New York Times. And the problem with that is that American culture, and not only American culture, Euro-American culture, is very, very comfortable with African suffering. That's Africa's job in Western discourse, is to suffer and to represent backwardness, to represent underdevelopment. It's very hard for Africa to fight its way out of that rhetorical position. And one should keep in mind that China has its own rhetorical position in that discourse, right? China is threat. That's China's role in that discourse. And so Africans have to work 4 times as hard to fight their way out of that discursive positioning, because it is then used to implicitly justify a lot of other nonsense, right? It's used to justify, for example, a focus on securitization of the relationship rather than on other forms of engagement. It's used to justify, like very unfair risk assessments, for example, for African financing. But there is this kind of fundamental problem of language and discourse that underlies this positioning of Africa in relation to the West that ends up serving the West, in a way that kind of ruins Africa's position in the world. And that, in the end, has to be is really this fundamental issue that has to be addressed.
So if you want to see how truly ridiculous all of this is, go to the Nigerian government's Debt Management Office website. That's dmo.gov.ng. Okay, dmo.gov.ng. On the homepage, you'll see a ton of content about all of the updates that the Debt Management Office, and by the way, the Nigerian DMO, in my view, is by far the best in Africa in terms of communicating debt issues.
Yes, excellent.
Bar none, okay? But there we go. On the homepage, lots of updates about all the different things that are going on, new reports that are coming out, in all caps, facts about Chinese loans to Nigeria. Okay, there we go. Now, here's what's so funny is that they posted that on September 11th, 2018, and they still have it up. Now, the reason why they still have it up is because this is continually an issue that they have to face. So they keep it up because they're continually bombarded by their own press, by their own legislators, by their own people about Chinese debt traps in Africa and Chinese debt in Africa that the DMO has to have for the past 6, going on 7 years now, a fact sheet about Chinese loans to Nigeria. What a waste of time and effort that we're still doing this. I mean, it's just mind-boggling.
Particularly because, as Kevin was pointing out, there are actual problems with some Chinese loans to Africa. And the debt trap is making it impossible for us to address those problems too.
Exactly.
It's maddening.
It is maddening. So I know regular listeners of this show might be like, oh, God, here they go again talking about it. But we just can't escape this, especially when we see, the great work that the Global Development Policy Center is doing and so many other scholars are doing, that it doesn't make any sense. And here's the other part that doesn't make sense to me, especially as an American. There is so much populist backlash in the U.S. today against the financial services industry. We hear endlessly about how the banks and corporations and Wall Street is just pillaging the American public. And yet, when we look at it overseas, they get a pass. BlackRock gets a pass. Bank of America gets a pass. In fact, they are seen as benevolent in many respects. That Chinese lending is malign and that Western lending through the Eurobond markets is benevolent, or at least benign at best. Okay? And that's a disconnect that I don't understand either. How can it be in the discourse domestically, these same congresspeople who are railing on the Chinese, who also rail on Wall Street, then give Wall Street a pass when they rape and pillage overseas? I do not get that. I will not understand that. There's a total cognitive dissonance on that.
I think it's partly this kind of discursive issue, is that when Americans suffer, it's an outrage. When Africans suffer, it's standard. Right? So African suffering is never an emergency. It's always normal.
No, remember India's External Affairs Minister, S. Jaishankar, talked about how that when the global North has problems, they want to socialize those problems to the global South. When the global South has problems, they want to privatize the problems.
It's their own problems, yes.
It's their own problems. That's not our problem. So, Ukraine, Gaza, that's a global problem. Or, the financial crisis, that's your problem.
Sudan is a local problem, yeah.
Yeah, Sudan, yeah, sorry. Congo, pick your crisis in the developing world and it's not our problem. The debt issue, it's not our problem. Anyway, but nothing gets us riled up more than this discussion. I feel my blood pressure. I can hear my wife going, stop talking about Chinese debt issues because you're going to have a heart attack when you talk about it. But it is one of these things that we just continually have to keep pounding through Because as you've pointed out, as Kevin's pointed out, there are problems with Chinese debt and Chinese financing, this emergency financing. We talked with Brad Parks over at Aid Data, and he was talking about the vast amounts of emergency financing that are flowing to developing countries that are not publicly tracked. That's a problem. That's a problem when the IMF comes in and wants to do a debt restructuring deal and doesn't have full visibility on a country's books. There are a lot of problems with the way that Chinese do overseas development finance. Let's focus on the legitimate, fact-based, evidence-based problems and not get caught up in these fairy tales. So I know I'm preaching to the choir to anybody who's lasted this long in the podcast. But there's no doubt that the cynics dropped off a long time ago. But I want to inspire those who are listening this far into the show to keep up the good fight in terms of fighting for fact-based arguments. So that is the last appeal. Okay, Cobus, let's leave the conversation there. We'll be back again next week with another episode. We do this show every week. We also have an Africa show that if you'd like to get that, you can either go to our website at ChinaGlobalSouth.com or you can sign up on Spotify or wherever you get your podcast. And we also produce a daily digest of the latest news that happened in China and the Global South. We're really the only platform of its kind that does this. We are 100% independent. We are editorially autonomous. We have no loyalty to any country, culture, company, you name it. We just try to give people a fair assessment as to what's happening and try again to do what we did today. And sometimes it means getting frustrated, but to do fact-based analysis. That is what we're trying to do. It's not easy to do, I'll tell you that. We get accused a couple weeks ago on YouTube in our feed. On the same day, in the same show, I got accused of being a CIA agent and a CCP hack. I don't quite understand how that happens, but that's kind of where we are.
What success looks like in our game.
That's exactly what success looks like. That means we are doing something right, if that's the assessment that I am, both a CIA hack and a CCP kind of agent, whatever it was on those, in the same show, in the same thread, like 5 comments apart. Okay, what are you going to do? But that's a sign of what we're doing. And I guess if that's coming out, then we're doing something right. So if you'd like to sign up and to check out the great work that Cobus and Diego and Johnny and Antonia and Lucy are doing all over the world, we've got teams in Asia, Africa, and the Middle East. Go to ChinaGlobalSouth.com/subscribe. We've kept subscriptions intentionally affordably low at $19 a month. Or if you are a student or teacher, email me, eric@ChinaGlobalSouth.com, and I will send you links for a half-off discount of just $10 a month. So let's leave it there, Cobus. I will be back with you next week. So for Cobus van Staden in Cape Town, I'm Eric Olander in Ho Chi Minh City. Thank you so much for listening.
The discussion continues online. Follow the China Global South Project on Twitter @ChinaGS Project and share your thoughts on today's show, or head over to our website at ChinaGlobalSouth.com, where you can subscribe to receive full access to more than 5,000 articles and podcasts. Once again, that's ChinaGlobalSouth.com.